Today's cryptocurrency market reflects an intense battle between valuation pressure and fledgling recovery attempts, with volatility defining most asset classes and pushing traders to reevaluate short-term risk. At the center of this storm, Bitcoin, the world's largest digital asset, continues to show both resilience and fragility within the same trading session. According to Analytics Insight, Bitcoin's price recently touched over $70,000, signaling bullish technical strength and renewed risk appetite after a period of heavy pressure. Yet Barron's reports an uneven global session where the world's benchmark crypto suffered declines alongside other major assets, with Bitcoin dipping near $69,800 before attempting stabilization. In fact, more detailed metrics show Bitcoin rebounding sharply from as low as $62,500 after a forced liquidation event last week, trading around $70,839 in recent sessions. A clear sign that buyers are stepping in after capitulation. This dual narrative, one of recovery and stress, perfectly encapsulates the mood among traders and institutional players. Just a few days ago, markets suffered substantial losses and systemic liquidations that pressured leveraged positions. But in the past 24 hours, investors have begun stepping back into the market. APA Economics notes positive momentum across the broader crypto market, with total capitalization rising as traders digest macro data and reposition portfolios for moderate gains. These mixed currents stem from a number of forces converging at once. On one hand, geopolitical and macroeconomic crosswinds have pressured risk assets, pushing Bitcoin into reactive swings. On the other, renewed entries by institutional buyers and technical rebound patterns have offered fresh speculation about a potential floor forming around long-term support levels. Altcoins present an equally complex picture. Today's headlines clearly show Dogecoin clinging to key technical support levels, with Analytics Insight indicating Doge maintaining roughly $0.094 on crucial buy zones, a remarkable performance given broader market stress. The narrative around Dogecoin often reflects broader retail sentiment and meme-driven cycles, but even here, the data suggests that buyers remain vigilant at support thresholds after weeks of downward pressure. XRP, another major altcoin known for its legal and regulatory backdrop, tells a different story. Ripple's flagship token has recently seen derivatives cooling, meaning traders are scaling back leveraged positions and hedging risk, which historically precedes pronounced price consolidation. This cautious approach to futures and options ties directly into broader market expectations about regulatory intervention and the timing of clarity around digital asset legislation. When we zoom out to macro performance and positioning, some metrics point to a tentative stabilization. Market sentiment indicators, such as the Fear and Greed Index tracked by community traders and analysts, had reached levels consistent with extreme fear, registering very low scores that often signal oversold conditions historically followed by rebounds. It's worth noting that these sentiment values aren't just arbitrary. They reflect real liquidation pressures, negative funding rates, and spikes in volatility across perpetual futures trading. Looking at exchange flows and behavioral data, many traders report that Bitcoin's drop below key psychological levels like $60,000 triggered significant stop-loss cascades, forcing leveraged positions to unwind and driving technical bounces as more aggressive buyers stepped into the market. Reports from futures forums highlight a flash crash to $60,008, followed by a rapid rebound above $70,000, resulting in over $2.6 billion in liquidations as fear peaked. These moves are symptomatic of a market that's both thinly supported at critical price levels and intensely reactive to forced selling. Stablecoins such as Tether, USDT, continue to perform their expected role as liquidity anchors, trading near their peg with minimal volatility, which contrasts sharply with the gyrations in the large-cap tokens. This relative stability is a reminder that, even amid stress, traders seek safe havens, and stablecoin volumes often spike during bouts of risk aversion. Despite the noise and rapid price moves, the broader macro context cannot be ignored, from regulatory headlines to institutional thesis evolution. In recent weeks, comments regarding stiffer oversight and scrutiny of digital asset platforms have weighed on confidence, contributing to defensive positioning across markets. This pushes traders into safety plays like spot stablecoins and short-term hedges, delaying potential recoveries until clarity improves around global regulatory frameworks. On the institutional side, some narrative threads suggest renewed interest in the digital asset class, albeit with caution. Big players are reportedly balancing between opportunistic buys at oversold levels and hedged bets against further volatility, striking a careful equilibrium that reflects both risk and reward potential inherent to crypto markets today. With prices in flux, retail traders and institutional participants alike are increasingly focused on macro drivers beyond crypto itself. Global equity movements, interest rate forecasts, and currency valuations now play out in parallel with ticket sizes entering digital asset markets. This cross-asset interplay has tightened price correlations, meaning Bitcoin and Ethereum often shadow moves in major stock indices or safe haven assets like gold. Amid all this, it's critical to remember that crypto markets aren't monolithic. Different assets follow divergent patterns depending on liquidity, real use adoption, and short-term trader behavior. Ethereum, the second largest crypto by market cap, has experienced distinct pressures tied to decentralized finance, DeFi flows, network usage costs, and validator economics, which sometimes diverge from Bitcoin's narrative. Evaluating the current setup through a strategic lens reveals that, while the short-term environment remains volatile and uncertain, signs of structural resilience are visible. Rebounds from oversold conditions, support retention at key technical levels, and renewed trading volumes all suggest that even if volatility persists, participants are not abandoning the crypto ecosystem. Instead, they're adapting to the market's rhythmic cycles of accumulation and dispersion. Looking ahead, several potential triggers could shape the coming weeks. Continued institutional inflows or broader macro stabilization might reignite bullish sentiment and encourage renewed risk appetite. Conversely, renewed regulatory uncertainty or adverse global economic data could intensify selling pressure, pushing prices lower and erasing short-term gains. For traders active today, managing risk remains paramount. Volatility is high, and leverage can quickly compound losses when price swings tighten. Many smart traders hedge their positions or redistribute risk exposure across multiple assets to weather unforeseen disruptions. If Bitcoin holds above crucial support benchmarks and buyers continue stepping in at lower ranges, it could set the stage for a more sustainable rise through the next resistance tiers, though this path is far from guaranteed. Commitment to disciplined risk management, combined with real-time data monitoring, is essential for navigating the turbulent waters of crypto markets in February 2026. In closing, the current cryptocurrency landscape is a vivid display of markets at a crossroads, driven by strong forces of fear and greed intermixed with cautious optimism. Bitcoin's oscillations around $70,000, altcoin behavior around key technical levels, and ongoing macro influences underscore a pivotal moment where smart capital and informed decision-making will likely determine the winners and losers in the months to come.